Welcome to The Explainer. Today, we're going to crack the code of stock analysis. We'll explore the two major philosophies investors use to pick winners and the exact tools they use to make their moves. So, let's dive right in. The stock market. It's like it speaks its own language, right? A mix of numbers and charts and all these financial reports. And at the very heart of it all is this one huge question. With thousands of companies out there, how on earth do you decide where to put your money? Well, investors typically have two main playbooks to answer that question. First, you've got fundamental analysis, which is all about picking the right company. It asks, what should I buy? Then you've got technical analysis, which is all about timing your move. It asks, when should I buy? Let's explore these two very different paths. So let's start with that first path, fundamental analysis. And honestly, following this approach is kind of like being a business detective. You're not just looking at the stock ticker, you're digging deep into the core of the business itself, looking for clues about its real underlying value. At its core, fundamental analysis is really a hunt for a company's intrinsic value. The theory is pretty simple. A stock's price might bounce around all over the place day to day, but eventually it's going to catch up to the company's true worth. Your job, as the detective, is to figure out that worth before everybody else does. Now, every detective needs their tools, right? And for a fundamental analyst, the magnifying glass and fingerprint kit are basically a set of calculations called financial ratios. These are these powerful little formulas that take all the raw numbers from a company's reports and turn them into actual, meaningful insights. And these ratios aren't just some random calculations. They're organized into 5 key investigative areas. Each category gives you a unique clue about the company's health. Think of it like interrogating a business from 5 different angles to really uncover the truth. Our investigation kicks off with liquidity ratios. This is basically the financial equivalent of checking a patient's pulse. Does the company have enough cash right now to pay its bills this month? It's the most fundamental test of survival, you know? Can they keep the lights on? Next, we look into the company's leverage ratios. This clue tells us how much of the business is built on borrowed money. Now, high debt can be like rocket fuel for growth, but wow, it is also incredibly risky. This ratio shows us just how much of a high-wire act the company's performing. Now for the efficiency ratios. This is where we pop the hood and really check the engine. How good is the company using its assets, its factories, its inventory, to actually generate sales? Is it a finely tuned machine, or is there a lot of waste and friction going on? I mean, at the end of the day, sales don't matter if they don't lead to profit. And that is exactly where profitability ratios come in. These are the moment of truth. How much of that hard-earned revenue actually becomes cold, hard cash? This tells you if the whole business strategy is actually paying off. And finally, our detective work wraps up with market value ratios. These tell us what other investors are thinking by comparing the stock price to things like earnings. Is the stock seen as a bargain right now, or is it considered way too expensive by the rest of the market? But what if you believe all that detective work, all those clues, are already reflected in the stock's price? What if the real answers aren't in the company's books at all, but in the market's behavior itself? Well, this brings us to our second philosophy, the path of the market chart reader. Yeah, technical analysis pretty much ignores a company's fundamentals. Instead, it focuses entirely on the stock chart. Technical analysts study historical price and volume data, looking for patterns that they believe can help predict where the price is headed next. And this gets to the core belief of technical analysis, that all that fundamental data we just talked about is already reflected or priced in to the stock. The real driver, they argue, is human psychology. Those predictable cycles of fear and greed that create patterns on a chart. So you can see the two approaches really are worlds apart. One is a long-term game of trying to find a company's hidden value through its financial reports. The other is a much shorter-term game of trying to predict the market's next move just by reading the patterns on a chart. Okay, so you've walked one of the paths. You've done your analysis, either as a detective or a chart reader, and you've formed an opinion. Now comes the moment of truth. How do you actually go and buy or sell the stock? When you go to make a trade, you have 2 basic choices. The first is a market order, where your priority is speed, get it done now. The second is a limit order, where your priority is getting a specific price. Let's see how that actually plays out. So let's imagine this simple scenario. You're ready to buy 100 shares of ABC stock. The very last price you saw on the screen was 200 rupees. Now you've got to decide how you're going to place your buy order. If you use a market order, you're pretty much saying, Buy me 100 shares right now at the best available price. Your order executes instantly, but you might pay a little bit more or a little bit less than that price you just saw, in this case, 200.10. You get your shares immediately, but you sacrifice some control over the price. Now, what if you use a limit order? This is totally different. Here, you're saying, I only want to buy these shares if I can get them for $199.50 or less. Your order just sits on the books, and it will only execute if the stock's price actually drops to your target. You get full control over the price, but there's just no guarantee your order will ever be filled. We've explored the detective's path and the chart reader's path. We've seen how to turn analysis into action. Now, let's put it all together and officially assemble your new investor toolkit. So here's your starter pack. You now have two distinct methods for finding opportunities: digging into a company's story or reading the market's mood. You've got the tools for that detective work. And you have two primary ways to act on your findings, one that prioritizes speed and one that prioritizes price. These are the foundational concepts for any investor. Ultimately, there is no single right answer in investing. So the real question now is, what kind of investor will you be? Will you become the patient value detective, uncovering those hidden gems, or the agile trend spotter, riding the market's momentum? The best investors often blend both. You now have the foundational toolkit to start forging your own path.